if gold is indeed hitting a record high, because the dollar is losing its value at its fastest pace in 50 years. The scarier question is, what is going on inside the financial system that no one is talking about? Are the cracks so deep that central banks are forced to hide them? Is confidence in the world's strongest currency collapsing faster than we think? When gold rises because of fear, it is no longer a market signal, but a warning to every investor that worse may be coming. Why is it so expensive? The price of gold has just officially surpassed the threshold of $4,000 per ounce. A figure that I and perhaps you thought would only appear in the hypothetical models of the economic world. But it has happened, right now. For the first time in history, the metal once considered real money has set a new record that has shaken almost the entire global financial market. International news agencies from Bloomberg, Reuters to Nikkei continuously run headlines like, "Breakout without breaks. Hard to stop." And the truth is that no one dares to guess where the next peak is. I remember a few years ago, when gold surpassed $2,000, many analysts called it cycle peak. They believed that the Fed would control inflation, the dollars would recover, and gold would return to equilibrium. But then the trade war dragged on, inflation refused to subside, central bank balance sheets ballooned like never before, and the US alone printed more credit than the entire money supply of the previous several decades combined. The result? Everyone rushed to gold, the only asset that cannot be printed, cannot be devalued, and does not depend on collective confidence. When the dollars weakened, US bonds lost their appeal, and central banks from China, India to Russia all increased their gold reserves. It was no longer a normal market signal. It was a sign of a change in the financial order. Gold was rising, but what was more frightening was paper money was losing value. As the classic saying in the financial world, gold is money, everything else is credit. Gold is real money, and the rest is just debt paper. Looking back at history, every time the world has been in turmoil, from the 1973 oil crisis, the 2000 dot-com bubble, to the 2008 financial crisis, gold has soared. But never before have we faced the combination of high inflation, record debt, protracted trade wars, and geopolitical risks like we are now. So when gold prices surpass $4,000, the right question is not, why is gold rising so much? It is, what is falling? What are we losing faith in? And perhaps you and I already know the answer. Title card gold has become the #1 safe haven asset as financial turmoil spreads and confidence in the dollars has weakened significantly in 2025. Global capital flows have shifted away from US bonds and poured heavily into gold, flooding social media with analysis videos and warnings of a new bull cycle in real life. Gold shops are always crowded, trading floors record a spike in trading volume, and precious metal ETFs continue to attract capital. All of this shows that defensive sentiment is on the rise, and gold is seen as a rare safe anchor in times of turmoil, historical context, and US dollar concerns in the past. Gold has always climbed whenever the world fell into great turmoil. In 2008, in the midst of the global financial crisis, gold surpassed $1,000 for the first time. During the COVID-19 pandemic, that number quickly rose to $2,000 as investors panicked and sought shelter. After tariffs and trade tensions under President Trump, gold continued to break out to the $3,000 threshold. Entering 2025, the dollar recorded its strongest weakness in 50 years due to record public debt, persistent inflation, and global foreign exchange reserves losing the proportion of the greenback. This wavering confidence became a direct catalyst for gold to explode more strongly than any previous cycle. The Debasement Trade explained, since the beginning of the year, the price charts of gold and the USD have almost mirrored each other in two opposite directions. Gold has been climbing steadily, while the USD has fallen to its weakest level in many eras. This argument is introduced in finance as the Debasement Trade, an investment line that comes from the belief that fiat currencies, especially the USD, are being devalued by the rapid growth of money supply and public debt. As the money supply expands far beyond the actual economic growth rate, advisors clearly recognize the depreciation of paper money. They understand that fiat money can be used more and more at any time to serve the policy of key documents and government details, while gold cannot. Gold is not controlled by central banks, is not dependent on politics, and cannot be created from nothing. Therefore, when confidence in fiat is shaken, money flows immediately to gold as a last refuge, and this is why gold is on its biggest rally in years. While the USD continues to weaken globally, Federal Reserve pressure and interest rate dynamics, the U.S. Federal Reserve is facing strong political pressure from the Trump administration, especially when the president continuously asks the Fed to cut interest rates to stimulate the economy. These repeated statements make the market worry that the Fed is losing its independence, a factor that is considered the foundation of stability of the U.S. financial system. When expectations of interest rate cuts spread, gold immediately becomes more attractive because the opportunity cost of holding precious metals is almost gone. Investors no longer receive significant yields from bonds or savings deposits, so they shift cash flow to non-interest-bearing assets that hold good value. On the other hand, inflation in the U.S. is still increasing, weakening the purchasing power of the USD every day. In this environment, gold is seen as financial insurance that helps preserve value and fight against the risk of devaluation of paper money. The combination of pressure on the Fed, expectations of interest rate cuts, and high inflation has made gold the priority choice of global investors. Impact of geopolitical tensions. The geopolitical crisis is spreading from the Middle East, Eastern Europe to the Asia-Pacific region, creating a world full of instability. Superpowers are constantly clashing interests, competing for influence, imposing embargoes, and expanding retaliatory tariffs. The U.S. has maintained a series of tariffs for many years, especially with China, causing the global supply chain to falter and market sentiment to become increasingly sensitive to risks. In that context, confidence in the stability of the international financial system has significantly declined. Many countries have increased their gold reserves to reduce their dependence on the USD, while individual investors are looking for assets that are outside of political fluctuations. Gold stands out as the number one choice because it is not affected by any government's policies. When risks escalate, the safe haven mentality becomes a natural reflex of the market. And gold, with its thousands of years of history of holding value, continues to be seen as the most solid defense. China's central role in gold markets. China is now the main driver of the global gold market, and this has never been more evident than in 2025. The country is both the world's largest gold consumer and the number one producer, consuming more than 10% of global production. But the most notable move has been by the People's Bank of China. For 3 consecutive years, the PBOC has been buying tons of gold coins every month, becoming one of the world's largest central banks in gold reserves. China's strategy is clear: reduce the proportion of U.S. bonds and increase the proportion of gold in its national reserves. This comes amid concerns about the devaluation of the U.S. dollar, escalating U.S. debt, and increasingly difficult to control geopolitical risks. Reducing U.S. bonds also means reducing the dependence on the greenback for international payments. When an economy with a size of more than $18 trillion actively turns to gold, the global market must react. International money has received this signal and quickly acted on it. This is one of the strongest drivers of the gold price explosion in 2025. U.S. dollar's declining reserve status. The share of the U.S. dollar in global foreign exchange reserves has fallen sharply from nearly 75% in 2000 to much lower. After the G7 froze Russian assets in 2022, many countries realized the risks of relying on the greenback. To avoid the risk of financial sanctions, they simultaneously increased their gold reserves as a safe hedge. ETF demand and investment flows. Gold ETFs have seen a surge in inflows in recent months, reflecting strong global investor interest. September alone saw inflows hit a more than 3-year high and 6 times higher than forecasts based on interest rate models. ETFs offer investors access to gold without having to physically hold it, reducing storage costs and increasing flexibility. This has fueled a surge in demand and contributed to a sharp rise in gold prices. Rally across silver and platinum. Not only has gold hit a record, but other precious metals, such as silver and platinum, have also increased sharply recently. Silver has even reached a 4-decade high, reflecting strong demand from both investors and key industries such as solar energy, chip manufacturing, and electronics. Platinum has also benefited from its important role in clean technology and automobile manufacturing. The general trend is that when gold increases strongly, the entire group of precious metals tends to follow, because they are all considered safe assets against financial instability and the weakening of fiat currencies. In the context of shaky confidence in the dollars and major currencies, investors seek precious metals as a defensive armor to preserve asset value. This creates a resonance effect, causing stronger cash flow into the entire group, contributing to pushing the prices of precious metals up simultaneously and maintaining a more sustainable increase compared to previous cycles. Cryptocurrencies, Bitcoin, and other cryptocurrencies are seen as a sign of resistance to the traditional financial system as confidence in fiat currencies declines. Investors see them as an alternative asset to gold, but cryptos are much more volatile and therefore carry higher risks. Future outlook. While many gold spells are entering a bubble phase, major financial institutions such as Goldman Sachs and Deutsche Bank maintain that the growth trend will continue. The reasons are the most fragile geopolitical confusion in many years, increased US-China competition, constantly changing economic alliances, the risk of widespread regional conflicts, and increasingly dense trade blows. These factors weaken confidence in the global financial system. In particular, the devaluation of the dollars and concerns about the possibility of US public debt in many countries, and institutional investors have to find safer places to anchor assets in an environment where fiat currencies can be diluted in value. Gold becomes a natural choice. Central banks continue to accumulate gold. ETFs attract strong capital, and individual investors bring demand to a record level. So, in today's uncertain times, gold is not only an investment asset, but also a safe haven that reflects concerns about the future of the global financial system. Why is it so expensive? If you find this video helpful, don't forget to like, subscribe, and leave a comment on what topic you would like me to cover in the next video. See you next time.